Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 231 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today we are going to be talking about when it comes to your investing, why doing nothing can many times be the best thing you can do. Because I think we get so caught up in market trends and we get so caught up in the things that are going on in the short term that we fail to take our long-term success into account. And we fail to take into account that things that are happening today won't necessarily be happening tomorrow. And that is something that I think really eats at our ability to make good returns over the long term. So I want to talk about why doing nothing is typically a very, very good strategy, and why when you have a good investment strategy, you shouldn't have to change it all too often. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things that I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you're interested in somebody helping you to create a financial plan and keep you accountable to that plan over the long term, then I can do that. Just go to any of my major social media platforms, Facebook, Instagram, Twitter, send me a message and tell me that you are interested in financial coaching sessions, and we can sit down and start working through your financial situation, creating goals that you can actually attain and move you further towards your long-term financial freedom goals and the ultimate goal of financial independence. You know, when you're coming off of a year like 2020 in the investing world, and that year was just full of exploding growth stocks that just took off, right? Out of the pandemic low, those growth stocks just absolutely exploded because a lot of them had to do with technology, and that technology being used even though the country was in lockdown, and a lot of new investors coming into the market and being interested in those particular companies, in those particular stocks, pushing the stock market higher and higher and higher, and people getting stimulus checks and investing those, and all these different things, all these different catalysts were reasons that the stock market was very attractive. Interest rates were very low, all these different things. Okay. And the stock market's very attractive. And so that pushed growth stocks very, very high in valuation. But then we get into 2021 and very early on this year, we kind of saw this beginning of a rotation. We saw this beginning of a change from the growth stocks to the value stocks, right? To stocks that are not necessarily the stay-at-home stocks, as they call them, right? Because those did amazingly well last year. The Amazons of the world, the Pelotons of the world, all those stay-at-home type things that you would do, right? But the trade has shifted into the more traditional stocks, into the things that are not stay-at-home, that are reopening trades, right? Because the world is reopening from the coronavirus pandemic. Okay, but it really makes me think, how many people are actually changing their portfolio based on these different market trends and based on these different things that are going on? And how much may it be hurting the individuals who are changing their portfolios, given the fact that long-term investing requires some conviction. Long-term investing requires ups and downs, right? Things just aren't going to go up all of the time. And we have to understand that. We have to know that that is the case. But we have to develop a good investment strategy, right? If your investment strategy is simply that you are systematically pouring money into index funds, mutual funds, ETFs that track the stock market and that are going to allow you to have a good long-term rate of return, then by all means, do that at all costs. If the market drops 50%, keep on buying. If the market's up 50%, keep on buying and average your cost into that, right? Have a good investment strategy. If you're out buying individual stocks, right? And these are specifically individuals who need to have a good investment strategy, because if you're buying individual stocks and you are, a crowd follower and you want to just go along with the herd, and you're not somebody who can have some conviction, you're not somebody who can hold on to something even though it's losing value and buy more because you understand the fundamentals of that business, then one, you may not need to be buying individual stocks at all. And two, you may just be flawed in your ideology around investing and around long-term investing in individual stocks and around what's actually going to make you returns, because the short term is not going to make you your returns over the long term, right? Your short-term returns may be great, right? You may have made fantastic returns in 2021, but you know what that means over a 40-year period? Really very little, right? There have been fantastic years over time. There have been fantastic years that, hedge fund managers and mutual fund managers have had, right? But then they kind of tend to be followed by some lackluster years, right? Because every dog has its day, as they say, right? Every investment manager, every portfolio manager, they have this particular ideology on picking stocks and picking companies that they employ into the particular fund that they run, right? And sometimes it works, and sometimes it works in a very big way. I think about Cathie Wood, right? I'm not saying Cathie Wood's returns may not continue to be good over the long term, but at least in the short term, they just blew everything out of the water last year. They were absolutely fantastic, right? But this year they have lagged, and that's not to say that they'll lag in the future, but it's a good example of how when a lot of people jump onto a particular boat just to get short-term gains, then there can be lags afterwards, right? And so a lot of really good fund managers end up having to pay out a lot in fund flows because people are leaving their fund just simply due to the fact that they underperform over some period of time. And what did people think? Did people think that as stock market valuations rose and rose and rose, that there wouldn't be some adjustment, there wouldn't be some change from these wood stocks, like Jim Cramer calls them, right? Where, Cathie Wood's buying all these high valuation, high growth names, some very large companies, some very small companies, owning a lot of Tesla, owning a lot of Bitcoin, all these different things, right? She's trying to capitalize on innovation. She literally has an innovation ETF, right? Yes, people are going to invest in those things. Yes, people are going to be interested in those things. But what do those things really speak to? They speak to the want to take short-term gains. They speak to the want to make some quick returns and not have to, over the long term, invest in a proper way. Because a lot of people think that they can make fast short-term gains and really make it rich and really move on up in the world and not have to worry about the traditional way of investing. And it happens, but it happens so rarely that the vast majority of us should not be thinking in that way. The vast majority of us should be thinking in the way of traditional investment strategies and moving ourselves right down the line and keeping with whatever strategy we choose to employ and allowing ourselves to continuously, systematically allocate capital into certain investments, okay? So what I really want to get down to today is, when should you make a change in your investment portfolio? When should you switch up your strategy? Is it ever okay to switch up your strategy? Should you listen to the talking heads on TV? Should you listen to the individuals that you see on CNBC every single day? Should you buy and sell at the rate at which they seem to be, wishy-washy on particular companies? And some people think you should, and some people think that you can make money in that way. But I'm of the opinion that they have their investment philosophy, and many of them are not true long-term investors anyway. There are a few, and I really, really respect their points of view, and I think that a lot of what they have to say is absolutely very good, right? But there are a lot of individuals on those shows that are traders, right? And traders are trying to make the short-term buck, and they are doing something in a way that you and I absolutely don't do, and we really can't do. Most of us can't do what a lot of those traders are able to do, because they have the power of a whole hedge fund behind them. They have the power of a research team behind them, right? They have all of these resources that we just don't have. They have a lot of money behind them. If they want to make a bet, they can make really, really big bets, or they can diversify their bets out a lot more. Whatever it is, right? They have some distinct advantages that we don't have as individual investors, right? But as individual investors, we have the distinct advantage to not have to look for short-term returns, right? If you're managing a portfolio or trading for a particular hedge fund or for a particular, investment company, whatever it is, right? Then you are going to have to keep with making good returns, or else you're not going to have a job very long, right? But the good news about being an individual investor is that you can lag for some period of time, but still win over the long term. And guess what? Nobody is going to be coming to take that money, and nobody is going to be speaking into your life like, hey, you better make good, better returns in the short term or else you're out of here. That's not the case as an individual investor, but we tend to put that pressure on ourselves time and time again. And I don't think that's warranted. I don't think it's warranted to put that type of pressure on ourselves as individual investors. The only pressure we should put on ourselves is if we're not at least keeping up with the market with our investments, then we're doing something wrong, right? Because you have the ability, you have the opportunity to just buy the market and keep up with it, right? And if you're not keeping up with the market, then you're doing something wrong. If you're not keeping up with the market over the long term, then you're doing something wrong. Okay. And maybe you need to consider just buying the market and moving on with your investment strategy. But nonetheless, okay, let's talk a little bit about, right, before we change our investment portfolio, some things that we need to consider, because I think that we are far too quick to change the thing that we are invested in or the thing that we're even speculating in, right? Just in the name of a changed rhetoric or just in the name of one news event over the short term. Because let me just give you an example from my own portfolio, from my own life, right? I own Peloton stock, right? And Peloton, some weeks ago, right, they had this issue with their treadmills, and they're still working through this issue with their treadmills. Okay, now the treadmills aren't a huge percentage of their revenues, but they are still a product that they offer, and it's bad whenever you have some type of product recall. Well, they had an issue with their treadmill, and a child passed away, right, because the way that the treadmill ran and kind of sucked things under it or whatever, right? And so there was a particular issue there. There was a big recall, right? And so you saw the stock dive. But if you understood the company, you understood what was going on. You understood that so many people had bought Pelotons and were still buying Pelotons, especially the bikes, not necessarily the treadmills at large, but their main, revenue source, the bikes, and then the subscriptions to the particular classes via the bikes, right? They would know that Peloton would make plenty of money out of that particular drop. And if you would have bought in that drop, you would have made quite the return since, because I think the stock dropped into the low 80s, maybe even the 70s. And now we're talking about a stock that's trading for $110 a share approximately, right? So you just have to have high conviction. You have to understand what you're invested in. But this was a place where I could have made the investment decision to just sell. Right? This was a short-term piece of news that I could have just sold and not worried about that anymore and gone into something else, right? But if you understand the company and you're willing to invest over the long term and you expect long-term returns to be good based on the price for which you purchased whatever asset, then you're going to be perfectly fine, right? And that's what I'm trying to talk you guys into doing, is making pragmatic investment decisions and making investment decisions based on fact, based on things that you know, and not based on ignorance and fear. So the first question that you should ask yourself before you make any type of investment decision in your portfolio is, what is your portfolio's purpose, right? You need to ask yourself, is the purpose of my portfolio to trade? Is the purpose of my portfolio to speculate? Is the purpose of my portfolio to buy individual growth stocks, or is it to buy value stocks, or is it to, is the purpose of my portfolio to pay for my kids' college? Is the purpose to retire on? What is the purpose? Right? Are you doing it for fun, or are you doing it for a specific reason because you're going to need that money later? Because without understanding the purpose, you're not going to be able to have a proper investment strategy and create proper investment goals. Okay, so we have to have a purpose behind our portfolio. Then once we set that purpose, we can move ourselves into actually making some legitimate decisions. Because the truth of the matter is, markets go up and markets go down over the long term. But you know what? Your purpose for that money is unlikely to change a ton, right? So if the purpose of the money is not likely to change a ton, why should you change? Why should your investment decisions, your investment strategies change a ton? And my argument is that they probably shouldn't, okay? So that's the first question you should ask. Second question you should ask before you make any type of investment decision is, what's going on in the macro market, right? Has the macro market phase shifted? And I think that this is a really good question to ask, because I was talking a bit ago about the growth and the value trade, right? And the reopening trade and the stay-at-home trade, all those different types of things, right? And those are macro market phases. They are macro market things that are going on, right? And the truth of the matter is, we don't want to just trade these macro phases, because they are exactly what we say, phases, right? And phases come and phases go. But we want things that are going to create value over the long term. So we don't want to worry about volatility, and we don't want to worry about just short-term shifts in the market, the ebbs and flows of growth and value and small and large and international and domestic. We don't want to worry so much about that. We want to worry about having a good strategy. We want to worry about having these good principles by which we make investment decisions, right? And then you don't have to worry about keeping up with these different, macro strategies. Because especially if you're picking individual stocks, there are always going to be stocks that their group is out of favor, and yet they do absolutely great, right? Because that's just a great company. And there's also stocks where their group, right, is doing fantastic, and yet they're lagging because that company may not be doing something that's particularly good over the long term, right? That's why Jim Cramer talks about buying the best of breed, buying the best of particular, areas of the market, of particular segments of the market, of growth or of value or of retail or whatever, right? So that's why he talks about best of breed. But if you don't own the best of breed, right, you can really get hurt. And even if you do buy something that seems to be the best of breed, and yet it lags over some period of time just based on valuation or whatever else, right, that can be problematic for you. Not to mention, if you own index funds or mutual funds, and that's how you invest primarily, which, like I've told you many times, we should be investing in funds because those are going to help us to create good long-term value. We shouldn't be putting everything into individual stocks, and the stuff that we do put into individual stocks, the money that we do put into individual stocks, right, should be invested in a way and with a mindset of the long term, right? We need to have a long-term viewpoint, and we need to have cool heads. And I've talked to you guys about all this before, and you can go back to those episodes and remind yourself what it should look like if you are going to own individual stocks, right? But if you own index funds, you shouldn't be jumping out of the S&P and getting into an international fund just because the domestic stocks are out of style and the international stocks are in style, right? That shouldn't be the case. And why are we not going to do this? Because you're going to miss something, right? You're going to miss returns switching back and forth because you're not likely to have the perfect timing of the shift, right? So you're likely to take some of the losses of the things that you end up selling and then miss out on some of the gains on the things that you end up buying, right? And that's going to be problematic over the long term. That's why we don't need to change our investment decisions just based on some shift in the macro market, all right? Then, third thing we need to ask ourselves when we are making an investment decision is, will you miss a market rebound by changing now? So that kind of goes to what I was just talking about, right? If, let's say, domestic stocks go into some gully for some period of time, okay, and international stocks are outperforming. Well, when domestic stocks eventually do come back, are you going to miss that? Right? Are you going to miss that rebound just by changing? Or last year during the coronavirus pandemic, you may have made the investment decision, which I have spoken against many times, to sell and to cut losses, right? As things were going down and going down precipitously, you might have sold, right? But if you were to have sold, you would have missed out on a lot of upside. So you should have asked yourself, will I miss a market rebound by changing what I'm doing now? And the obvious answer was yes. Of course you'll miss a market rebound by selling when things are down so low, because they have always rebounded, and there's no specific reason that the market would lose 35% of its value over the course of a couple weeks, okay? So will you miss a market rebound by changing now? That's something you need to ask yourself. Then number 4, okay? Are you just following the crowd? And this is one of the biggest questions that you need to ask yourself, okay? Because if you are just following the crowd, you might as well cut it off right there. You might as well stop what you're talking about, stop what you're doing, and just not do anything, right? Because if you are going to follow the crowd, you're going to get your tail whooped in investing for many reasons, okay? But most of all, following the crowd means that you're already late. Means whatever trade you're trying to jump into, whatever asset class you're trying to jump into, you are already late. And the fact that you're already late means you are going to miss out on returns. And a lot of following the crowd comes from FOMO. It comes from that fear of missing out. But the irony in all of it is that you are likely to miss out by going and investing in that thing or speculating in that asset. You're likely to miss out. You're likely to miss out on the gains it's already made. Just think about how many people jumped into crypto at its all-time highs. Think about how many people have taken some huge losses by doing so. Think about how many people bought Tesla stock at all-time highs and have taken some pretty deep hits since that big fall in price, right? Think about those types of things, because those individuals followed the crowd, and following the crowd only gets you in trouble when it comes to your investing strategy. So we need to make sure that our investment decisions aren't based on the crowd, right, but are based on our own fundamental analysis, our own analysis of a company or of a particular investment or asset class, right? And we can make those decisions for ourselves. Now, I'm not saying that other people can't have good commentary and good ideas and good reasons to buy things that you may concur with, right? But do your research and understand those things. Don't just follow the fact that a bunch of people bought Tesla, or a bunch of people bought Bitcoin or Ethereum, or whatever, right? Don't just follow the crowd. Be a bit contrarian. Right. And just being a long-term investor, just being somebody who buys and holds and holds and holds and holds and holds over the long term makes you contrarian, makes you different from the market at large. Right. And it would mean you're not following the crowd. So are you following the crowd? Then before you make an investment decision, you need to ask yourself, have your goals changed? Okay, because if your goals change, then it may be okay to change your investment strategy, right? If you start off and you're putting money away in a brokerage account for your kid's college, and you're putting money away, doing it in a certain way, right? And then let's say you get to the point where your kid's going to go to college and they get a full ride scholarship, right? And they keep that full ride scholarship and graduate from college. Well, you still have all that money. Well, your goals for that money have likely changed. They've likely changed from paying for college for my child to retiring, or retiring early, or going on these big trips, or buying this house, or doing these things that we want to do, right? Doing all these fun vacations or whatever, right? So your goals may have changed in that place. And that is a pretty good time to reevaluate your investment decisions, reevaluate your investment strategy, and see if a change in investment strategy is warranted. Because if your goals aren't changed, right? If you're still going towards the same goal, and yet you completely change course of your investment decisions and your investment strategies, it is likely that you're being strayed by some different forces that you shouldn't be strayed by, and you should stay on the path toward the particular goals that you have, right? Then, are your decisions being driven by fear or anxiety? This is so huge. So many people are scared. Right? So many people are scared to underperform. They're scared. They fear missing out. That's the huge thing, right? Fear of missing out, FOMO, right? People are scared to not be in on what everybody else is in, right? They're scared to watch their friends invest in something and make money and them not make money. I heard a comedian say recently that, they on one of their podcasts that, the only reason that they invested in Bitcoin is because I'm not going to sit around and let my friends make money and me not make money. That is fear of missing out. That is investment anxiety. We need to make sure that this does not play a part in our investment decisions, because when we invest out of fear, what we tend to do is we invest at horrendous prices for horrendous reasons, and we tend to get horrendous returns. Okay, so we need to make sure that we are not investing out of fear or anxiety. And if you aren't making an investment decision that is based on fear or anxiety, then you can kind of continue on in some of these questions that you should ask yourself. Then you also need to ask yourself if you are being proactive or if you are being reactive. Ask yourself if you're being proactive or reactive in your decision to sell. Stocks drop and spike often. If you feel as though your decision to sell is an immediate reaction to a sudden drop, take a moment to do some research. Go back and think about that Peloton example that I gave, right? It was very tempting to sell something like that that has a precipitous drop for a particular reason. It had a drop for a reason, right? But was the entire drop warranted? Absolutely not. And you would have only known that if you could have done your own research, right? That would have been reactive to the particular trade. But what do? I see a big drop, I buy more, right? And why do you buy more? Because that is being proactive, right? You're being proactive in seeing what's going on, being able to do your research, and then realizing that the market is overreacting to something that is going on and continuing to place capital in that place, because now you're getting whatever asset it is just at a discount. Okay, so we want to be proactive in our investing approach, not reactive. That kind of goes with following the crowd, right? We don't want to follow the crowd. We want to make our own decisions, and we want to get ahead of any particular situations in our investment portfolio that may be a cause for concern. Okay, then what can you afford to lose? That's a question you need to ask yourself, right? Because if you're investing for, let's say, your kid's college, and your kid's college is coming up pretty fast. Let's say you've only got 10 years. You can't afford to lose a ton of that, okay? Or if you're investing over the long term and you need money for retirement, right? You can't afford to lose a ton of your retirement money, especially as you get closer and closer to your retirement. Or let's say you're already retired, right? And you have an investment portfolio. You can't afford to lose a ton of that money because you're trying to live on it actively. Okay, so the less you can afford to lose, obviously the less risk should be taken, right? And that doesn't mean that there shouldn't be some stocks in your portfolio. It doesn't mean that there shouldn't be some volatility in your portfolio. It just means you need to be selective in the decisions that you make. And so when you go to make an investment decision, you need to understand, can I lose what I put in here, right? And obviously not all investments should be expected to say, I'm willing to lose all of it. That's just our speculation portion, right? But we should have an understanding of what am I likely to gain from a particular investment and what can I really afford to lose here? And it can help you to make better investment decisions as you move forward. And then how long is your time horizon? Goes right along with what I was just talking about, right? If you have a really long-term time horizon, then you can take some more risks in the short term. You can take some more fluctuations in price and value, right? You can absolutely do that. And you can buy some things that are more growth oriented and have better long-term prospects, right? As long as you're willing to look at the long-term and not the short-term, right? Your time horizon is going to tell us a lot of things. If your time horizon is very short, maybe you shouldn't be investing at all, right? If you need a car in 3 years and you're trying to put money away for that car, maybe you should just save the money and not make the decision to invest that money in order to grow it to buy that car, because you're more likely to lose money in the short term by trying to invest in that way. Right? The purpose of the money within your financial plan should drive investment change, not the actual markets that we cannot control, right? So your purpose is directly tied to the time horizon that you have, right? Because that time horizon, the end of the time horizon is, whatever purpose is what we're going to have to use that money for. Okay, so the purpose of the money is going to drive the investment change. If you need to make changes in your investments, that's why you see people reallocate and take less risk over time, because their time horizon is changing. Okay, so that should be a reason that we make some type of investment decision. Then, are you sticking to your overall game plan? Look. We need to stick to whatever we're doing, right? If our game plan is to buy index funds and be passive over the long term and not do any individual stock investing, then don't get drawn by the allure of your friends making quick money, right? Don't get drawn by that. Okay, stick to your game plan. If your game plan is to buy value stocks and allow them to appreciate over time, don't get caught up by growth stocks when they rear their ugly heads and their valuations fly up and it looks like that's the only place to make money. Right? Stick to your game plan, because over the long term, sticking to a plan, not doing a lot of selling, buying and holding good assets is going to make you better returns over the long term. Then, what is the risk level of the investment? Obviously, the last thing you want to do is lose money in the stock market, right? Even though higher risk opportunities may look enticing, you can lose money fast. Now, this is not to say that you should never take risk, right? I think risk is inherent and you should take the amount of risk that is appropriate to your particular risk profile, okay? But on the other hand, right, we have to be reasonable. We have to understand that even though we may be willing to take a certain amount of risk, that risk needs to be commensurate with the returns that we expect to make. If we expect to make really high returns, you're going to have to take some risks. That's why, when I hear people say, in their 30s or 40s, I just don't like the stock market. I don't like the idea of the stock market. I don't want to invest in the stock market and lose all my money, all this type of stuff, right? They are perceiving risk in the stock market, okay? And there is risk in the stock market, but there tends to be far less risk than they think and far greater returns come than they may think, right? And then they also tend to expect stock market returns from lesser risk. And that's just not going to be the case. If you take less risk, you're likely going to get less return. That's one of the major tenets of finance, one of the major principles that you learn in finance classes in college, right? Okay, so we need to remember the risk level of the investment, and that should better inform our investment decisions, okay? Then you need to ask yourself, am I staying true to my long-term goals? Am I staying true to what I said I was setting out to do? And especially if, you already own a company or own an investment, right? You really need to ask yourself before you go and just sell it because it's dropped some, or sell it because it's made a certain amount in return, right? Am I staying true to my goals? Am I staying true to the reason that I bought this in the first place? Am I staying true to the fact that I am a long-term investor and I know that this company's fundamentals work in a certain way and that they are going to continue making money or not continue making money, whatever it may be, right? Are you staying true to your long-term goals, and are you only making decisions based on whatever those goals are and based on whatever reasons there were for you purchasing something in the first place or for having this money invested in the first place? Okay. Then lastly, another question that you need to ask yourself is, are you trying to get even? During volatile periods, investors feel the pain of a loss more deeply than the joy of a gain, right? It's a behavioral insight we call get evenitis, right? Which is the concept of I will sell when the price gets back to where I bought it. Okay, this is a trap to avoid because every day that you decide to hold a stock, bond, investment, whatever, that has a paper loss, you're actually making a decision to buy it. Now, I think that's a really big thing that we have to understand is every day that we hold something that we shouldn't be holding, or we hold something that's not in line with our investment strategy, you're making the decision to buy it every single day because you could just liquidate it and purchase something that is in line with your investment strategy. Okay. But are we too caught up in just trying to get even with our losers? Because we all have losers. Everybody has stocks that they lose on. Right? But obviously you want to have way more winners than losers. And some losers turn out to be winners over the long term because those companies actually have some value to them. But maybe you got in at a high price, a high valuation. Maybe you bought it and the stock immediately fell, which tends to be the case with a lot of investors. Peter Lynch talks about that all the time, and I've examined that in my own investing strategy, that I'll buy something and then the next day it falls 4%, and you're like, well, okay. But if you're investing for the long term, you shouldn't care, first of all, right? And then second of all, holding things longer, you see that value play out, and you see that short-term fluctuation meant absolutely nothing to your ability to invest in an appropriate way. So we need to take all these things into account when making investment decisions and not be so rash, right? Don't make investment decisions just because your buddies make them, right? Make investment decisions because you do the research and you understand what you are investing in, and don't just follow the swings of the market. Doing nothing is better than following those swings of the market. Doing nothing and sticking to your guns, sticking to your strategy. When I say doing nothing, I'm not talking about literally not investing. I'm talking about sticking to your guns, not making changes, right? Can be one of the most valuable things you can do. Now, if you go through all these questions and all of them point to you making some type of change, then by all means, make some type of change, okay? But I am going to guess that in most situations, right, you're going to look and you're going to go through these questions and you'll find at least one that really pokes a hole in your willingness to buy something or your willingness to sell something, okay? And if it does that, then listen to the proper answer to the question. Listen to your long-term investing strategy. Listen to your long-term investor self and not your short-term trader self who can be a literal trader over time. So thanks for watching this episode. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just go to any of the major social media sites, then just send me a DM, right? And say that you're interested in financial coaching sessions, and we can set up a financial coaching session or a number of financial coaching sessions to get you on the right track financially, to create some financial goals that you can actually attain and push you on towards long-term financial freedom. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.